my dear students. Welcome to our RTP discussion session. Myself, Professor Gaurav. Today, I would be discussing with you November 2022 attempt RTP. Also, there are few amendments which we need to discuss before we go for discussing the RTP. The first amendment, my dear students, is with respect to property, plant, equipment. Now, if you remember, in our classroom sessions, we had discussed cost of PPE. So, while discussing that cost of PPE measurement part, all direct expenses, present value of cost of decommission, and net cost of test run were added to the cost of PPE. So, when we say net cost of test run, what does it mean? It means that if we do test run and after doing test run, there are certain products which are made during that test run, they will be sold off. So, if I am incurring a test run of 500 and a product is manufactured in that process of test run and I get say 400 rupees. So, we used to say 500 minus 400, 100 rupees will form part of my cost of PPE. This is what we did, and that is correct. But what if the sales proceeds are in excess of the cost? I incurred test run of 500, but I received 700 from sales proceed. So 200. What should be done with respect to 200? As per IAS 16, this 200 is to be credited to profit and loss account. But my dear student, we have a carve out. As per Ind AS 16, the 200 which represents excess sales proceeds from sale of goods produced during test run is to be reduced from the cost of PPE. I repeat, if our net cost of PPE is a negative amount, then as per Ind AS, that has to be reduced from the cost of PPE. Whereas under IAS, the net cost of PPE, if it is negative, negative means the sales proceeds are more than its cost, then as per IAS 16, the same is credited to profit and loss account. So friends, that is the first part with respect to our Ind AS 16. So my first amendment is over. Now we have a next area which is not that big amendment. It is with respect to the normal requirement. Ind AS 37. Now friends, under Ind AS 37 we had something known as onerous contract. If you remember, what was an onerous contract? Onerous contract are those contracts where the unavoidable cost to meet the obligation under a contract exceeds the economic benefits generated from such contract. Then we say the contract is onerous. Now, we have to create provision that is for those unavoidable cost. Everybody knows. So, not a big amendment also. But while creating provision, friends, what costs are to be considered? So, all those incremental costs that are required to fulfill the contract will be considered. This is what we had. Now, as per the amendment made, even directly attributable cost will form part of my unavoidable cost. Like, in order to fulfill a requirement or an obligation under a contract, I am using an asset. So, earlier what we used to do, whatever the incremental cost of using that asset, we were including it in our unavoidable cost and creating provision with respect to it. Now, the standard uses the word assets used in fulfilling the contract instead of assets dedicated to the contract. Now, because it says assets used in fulfilling the contract, my dear friends, what is the impact of this is, I am going to take all the expenses which are directly attributable with respect to that particular asset. That may be depreciation, impairment loss, and all those things have to be considered, because the standard has now replaced the term asset used in fulfilling the contract. Of course, as far as 103 is there, you may just have one reading, my friends, because that's not the big amendment which has an impact directly on our exam. It is just with respect to the change which has been done in Ind AS 1. Nothing but, I can say, conceptual framework for preparation of financial statements, levies. Yeah. So, how should those levies be recognized? So, there was a conflict between Appendix C and the framework requirement, which has been taken care of. So, we need not go in those small areas. You can just have one reading. Ind AS 101 read along with Ind AS 21. Oh, I'm sorry. So, those translation difference at the time of adoption of Ind AS with respect to currency fluctuations which we were accumulating under our previous gap, they were always considered to be zero on the date of transaction. Now, that was considered for our entity. But what if I am preparing CFS? Then should I consider those translation loss to be zero even for my subsidiary? So now, henceforth, D13A has been inserted in 101, which removes the conflict between requirement of para of 10, which provides exemption where subsidiary adopts Ind AS later and its parents, and the exemption on cumulative translation difference at the carrying amount included in parent CFS. Okay, so where the Ind AS has been adopted by the subsidiary later on and the parent has adopted earlier, then there was a conflict that when should we consider this translation difference to be zero. So that conflict has been removed. Moving on to 109, this is a new stuff and I would like you to remember this point also. See, amendments are there, but all amendments from examination point of view, we need to have one glance over it. Like, we had a concept of derecognition of a financial liability. When should we derecognize a financial liability? So, my dear friends, that financial liability is to be derecognized on substantial modification. Now, what do you mean by substantial modification? When there is a substantial modification. So, we used to say, if the liability is modified and the present value of the modified cash flows discounted using the original EIR, find out that and find out what is the present value of the remaining cash flow of the original liability. If the difference between these two is 10%, then we used to derecognize the existing liability and recognize the new liability. I hope you remember that point. But now, friends, what is the new stuff under 109? So, while determining the cash flows, the fees paid and fees received should be included or not was not mentioned in the standard. Now, after the amendment made in 2022, it clarifies that the fees paid for the purpose of modification will now be includes amount paid by the borrower to or on behalf of the lender, and fees received includes fees amount paid by the lender to or on behalf of the borrower. Okay, so the cash flows, when we are finding out those cash flows will now include the fees. That clarity has been given. Coming on to Ind AS 41, nothing but while considering fair value, certain cash flows would not be considered. So there was a list, this cash flow should not be considered for the purpose of determination of fair value, in which cash flows for taxation was included in the exclusion list. Now the amendment has deleted the cash flows for taxation from that exclusion list. It means that the tax cash flows must be included in measurement of fair value. Okay, so few amendments, out of which I think Ind AS 16, the important part, that the amount should not be credited to P&L, that amount should be reduced from the cost of the asset only. Test run, net test run. Now friends, let's start with our RTP discussion. Ind AS 101, 102 and Ind AS 8. Ind AS 101 first time adoption, 102 share based payment, and Ind AS nothing but standard pertaining to errors accounting policies. On 1st April 2001, Newgen Limited granted 1,20,000 share option to its employees, with vesting condition being a service condition as follows. Vesting date 31st March 2002, 80,000 share options, 1 year vesting period since granted. Second, vesting date is 31st March 2005, 40,000 share options, 4-year vesting period since granted. Each option can be converted into 1 equity share of Newgen Limited. The fair value of the options on the grant date, that is on 1st April 2001, was Rs 20. Newgen Limited is required to prepare financial statements in Ind AS for financial year ending on 31st March 2004, the transition date for Ind AS being 1st April 2002. The entity has disclosed publicly the fair value of both these equity instruments as determined at the measurement date as defined by Ind AS 102. The previous applicable GAAP for the entity is IGAAP, accounting standards, and therein the entity had not adopted intrinsic method of valuation. The shares options have not been exercised by employees of Newgen Limited. How the share based payment should be reflected in the books of Newgen Limited as on 31st March 2004, assuming that the entity has erred by not passing any entry for the aforesaid mentioned transaction in the books of Newgen on the grant date, that is 1st April 2001. Okay, my dear friends, a very small point. Now, if you look properly, when does my year begin? Current year, huh? My current year is ending on 31st March 2004. So it is 3-4. Now what was the date of grant, friends? What is the date of grant? 1st April 20x1. I'll just use the word 2001 and something like that. Now this is the date of grant, friends, 1st April 2001, and there you are giving 2 share based payment plan. The first plan is there and the second plan is there. The first plan requires 80,000 option and the vesting date is 31st March 2002. Whereas second plan is nothing but 40,000 options and the vesting date is 31st March 2000 x5. And friends, what is our current year? 3-4 is our current year. Now what has happened is the entity has missed out recognizing on 1st April 2001 that we have a share-based payment plan. Of course, the date of transition to Ind AS is what date? First April 20x2. This is the date on which you transit to Ind AS. So obviously friends, my current year is 3/4. It's 2/3 and my opening balance sheet will be on 1st April 2002. Now friends, I would like you to just remember that we had done something known as transition adjustments under Ind AS 102. Now what are those transition adjustments? As per Ind AS 102, when an entity adopts Ind AS for the first time, then it has an option not to apply. It is an option not to apply the principles of Ind AS 102 to all those options which have been vested prior to the date of transition. All those options which have been vested prior to the date of transition, that option, exemption is available. But all those options, share options, which are vested after the date of transition, for that the exemption is not available. So if you look properly, this Newgen Limited can adopt the exemption of not applying the principles of Ind AS 102 to this 80,000 option, because this 80,000 options are vested on 31st March 2002. But as far as this 40,000 option is concerned, you cannot adopt that exemption. For 40,000 option, the entity has to apply the principles of Ind AS 102. But the problem is that if you read the question, friends, how should, read this point, friends. Entity has erred by not passing any NT for the above mentioned transaction in the books on the grant date. You have made an error by not passing any accounting for either 80,000 options as well as 40,000 options. Now, if the entity would have applied the principles of IGAP, that is nothing but ESOP guidance note was there, then as per Ind AS 102, the options which have been vested, your exemption is available. But the entity did not apply only the requirement of IGAP, that is accounting standards I can say, or to be precise, the guidance note. It means the exemption option cannot be exercised for these 80,000 options. Means compulsorily the entity needs to apply the principles of Ind AS 102 for 80,000 options. Of course, for them the vesting period is only 1 year, that is 1-2. Whereas here the vesting period is 1-2, 2-3, 3-4 and of course 4-5. So the exemption option cannot be applied. Now I will be applying 102 right from 1st April 20x1, which means whatever is the cost arising for 1-2 pertaining to 80,000 option. I don't have 1-2, my friends. I don't have 1-2. So whatever is the cost pertaining to 80,000 options, that is nothing but 80,000 options into fair value. which is nothing but given in the question, the fair value is 20. So 80,000 into that 20, that amount will be recognized in the books by passing an entry retained earning account debit to share based payment reserve. Retained earnings, so it's obviously going to affect my opening balance sheet. It's going to affect my opening balance sheet 1st April 2002 pertaining to 80,000 option. As far as 40,000 option is concerned, of course 40,000 option into 20, so my total cost comes to 8 lakhs. And this 8 lakhs is cost for the vesting period, which is 4 years. So every year the cost will be 2 lakh, 2 lakh, 2 lakh and 2 lakh. And we are here in 3-4 friends, which means that for 1 to 2 lakhs will be adjusted through retained earnings only, 1 to, because that is nothing but the period prior to my previous year. So 1 to 2 lakhs will be adjusted through retained earnings. That is nothing but retained earnings account debit to share based payment reserve. As far as 2-3 cost is concerned, that will be given effect in 2-3 itself only. And as far as 3-4 cost of 2 lakhs is concerned, that will also be given effect in 3-4 by debiting employee benefit expense and crediting share based payment reserves. 4-5 2 lakhs is concerned, that is not to be accounted now, that will be accounted as and when the period comes. So friends, 3 standard got combined. First time adoption 102, and of course there is an error, and this errors pertains to previous year as well as is pertains to the period prior to the previous year. Hence the changes will be made in opening balance sheet. We have a solution here in front of you. You may just have an idea with respect to it. For 1 to, only 1 year vesting period is there because of that 80,000 options. Another 40,000 options, 8 lakhs is the fair value, and every year 2 lakhs will be recognized. Now friends, the next Ind AS is 116. Nothing but we are a manufacturer, dealer lessor. A company manufactures specialized machinery. The company offers customer the choice of either buying or leasing the machinery. A customer chooses to lease the machine. Details of the arrangement are as follows. The lease commences on 1st April 2001 and lasts for 3 years. The lessee is required to make annual rentals of 57,500. The leased machinery is returned to the lessor at the end of the lease. The fair value of the machinery is 150,000, which is equivalent to selling price of the machinery. The machinery cost is 1 lakh to manufacture. The lessor incurred cost of 2,500 to negotiate and arrange for the lease. The expected useful life of machinery is 3 years. The machinery has an expected residual value, does not change over the lease term. Expected residual value of 10,000 at the end of year 3. The estimated residual value does not change over the lease term. The interest rate implicit in the lease is 10.19. The lessor classifies the lease as a finance lease. How should lessor account for the same in the books of accounts? Past journal entries. Yes, my dear students, your annual lease rentals are 57,500. The cost is 100,000. Initial direct cost 2,500, and the expected residual value, can I say this is nothing but your UGRV. You are a manufacturer dealer. How would you deal with the stuff when you are a manufacturer dealer? Can I say a very simple stuff? I can just directly go on it. That the asset, I'm a manufacturer dealer, then obviously that asset is going to be credited. So inventory will be credited based on its book value, which is 100,000. Machinery cost to the manufacturer is 1 lakh. So the amount will be credited will be 1 lakh. I have to receive lease rentals. What are the amounts of lease rental that we will be receiving over a period of time? How much amount I will be receiving plus the UGRV. So it is nothing but 57,500. This is the amount plus the UGRV 10,000. But of course, that should be discounted using our discount rate, which is 10.19. So my friends, 1 divided by, you would be getting 57,500 into present value annuity factor at the rate of 10.19% for 3 years, and 10,000 into discounting factor at the rate of 10.19% for 3rd year, which is nothing but 150,000. Lease receivable. What is my cost of sales? The cost of sales will be nothing but the cost of inventory minus present value of UGRV. The cost of sales, I repeat, is nothing but present value, the inventory cost minus present value of UGRV. And my revenue is nothing but sales revenue, the lease received minus present value of UGRV, and the amount which we paid, 2,500. So this same type of question we had in our textbook. I'll just go through the solution. The cost to lessor of providing the machine on lease consists of book value of 1 lakh plus initial direct cost associated with entering into the lease, that is 2,500, less the future income expected from disposing the machine at the end of the lease, that is the present value of UGRV, 10,000, being 7,470. This gives cost of sale of 95,030. This is my cost of sales. The sales profit will be 47,500, and the amount with that I have to receive is nothing but the fair value of the machinery. Okay, then we have that amortization table. Of course, at the end we will be left out with 10,000. Why we will be left out with 10,000, friends? We will be left out with 10,000 because the UGRV is 10,000. Expected residual value is 10,000. So you may just have a glance over it, not that much difficult at all, because such type of question has been done by us in the classroom also. Okay friends, now let us jump on to Ind AS 20 question, which is government grant pertaining to interest-free loan. To encourage entities to expand their operations in specified development zone, the government provides interest-free loan to fund the purchase of manufacturing equipment. In accordance with the development scheme, an entity receives an interest-free loan of 500,000 from government for a period of 3 years. The market rate of interest for similar loans for 3 years is 5% per year. There is no future performance conditions attached to the interest-free loan. Discuss how to account for the above loan, pass necessary journal entries in the entity's books of accounts from year 1 to year 3 as per relevant Ind AS. Very simple friends, 5 lakhs is the loan. We have taken a loan of 5 lakhs. Now if I have taken a loan of 5 lakhs, this I am going to pay when? At the end of 3rd year. So I will be discounting that 5 lakhs at the rate of 5% based on the discounting factor for the 3rd year. So I will be getting present value of the 5 lakhs which I pay, because if you look properly, what is the outflow in the year 1, 0, year 2, 0, year 3, 5 lakhs into the discounting factor. So I will be getting the present value of the loan, or I can say fair value of the loan. And what we will do, we will compare the proceeds received, with the fair value of the loan. Difference is nothing but government grant. And this government grant will be credited immediately to profit and loss account because there is no future performance conditions. There are no future performance condition attached to this loan. So the whole amount will get credited to P&L, and that grant fair value, difference between the fair value and the proceed received is the grant, goes to P&L. What about the loan? The loan will be obviously be subject to amortization table. We will be having opening balance plus interest minus payment 0, closing balance, and so on. Okay, so they were just asked to pass us the entry. So very simple area, 5 lakh discounted. So we get 4 lakh 32,000. 68,000 will go to P&L. So our entry is cash bank account debit to loan, financial liability to income, 68,000. Then every year amortization table, finance cost to loan, finance cost to loan, finance cost to loan, and at the end everything is over. The amount is 5 lakhs based on the amortization table. I hope you remember the table which we have been preparing for maximum of the questions. Now friends, a small theoretical question is there pertaining to Ind AS 1. As per statutory requirements, exceptional items are required to be disclosed, whereas Ind AS 1 requires separate disclosure of material items, and how these are to be presented in financial statement. Does it imply that exceptional means material? Give examples. How should it be presented in the financial statements? Now my dear friends, if you look properly, what is an exceptional item has not been directly defined by Ind AS, but if you remember, I used to give you this word SIN. Looking at the size, the incidence and nature of the item, obviously material. If looking at the size, incidence and nature, the entity feels disclosing that item would obviously enhance the readability and the utility of financial statements, then those items have to be disclosed separately. Yeah, so a very theoretical area, SIN point, you may just have a, this is the point friends. When an item of income or expense within the profit or loss from order such size, nature or incidence, the disclosure is relevant to explain the performance of the entity, then such items should be disclosed separately. Generally, the items of income or expense fulfilling the above mentioned criteria are classified as exceptional items and are disclosed separately. Now, all material items are not exceptional items. In other words, exceptional items are those items which meet the test of materiality, size and nature, and test of incidence. Like you are writing down your inventories, reversal of those write downs, disposal of PPE, litigation settlement, some discontinuing operation and all those things. So these are the things which we disclose separately to enhance the user experience. Now friends, let's jump on to the next Ind AS, that is Ind AS 12. Of course, this question is not directly on Ind AS recognition of deferred taxes, but it is more about reconciling why tax expenses per books and actual tax expenses differing. Following is the summarized P&L of Earth Limited as per Ind AS. Revenue from operation 1160, other income 56, so total income is 1216. Purchases of stock in trade 40, changes in inventories of stock in trade 6, employee benefit expenses 116, finance cost 130, depreciation and amortization expense 30, other expense 300, total expense 622. Your profit before tax, that is nothing but A minus B, gives me 594. My current tax is 165.40, deferred tax is 1.50, tax expense is 166.90. That is nothing but combination of these two, tax expense. And my profit after tax is 427.10. The additional information has been given. Corporate income tax rate applicable to Earth Limited is 30%. Other income includes long-term capital gains of 10 crore which are taxable at 10%. Other expense excludes following items which are not deductible for income tax purpose like penalties, impairment of goodwill and CSR. Other expense includes research and development of 8 crores in respect of which 200% weighted deduction is available under income tax law. Other income includes dividend of 4 crore which is exempt from tax. Profit before tax of 594 crore includes agriculture income of 55 crore, which is exempt from tax. Profit of 60 crores earned in USA, on which Earth Limited is required to pay tax at the rate of 20%. Depreciation as per income tax law is 25 crore. During review of the financial statements of Earth Limited, the CFO multiplied the profit before tax by the income tax rate and arrived at 178.2 crores as the tax expense. That is obviously. However, the actual income tax expense appearing in the summarized statement of P&L is 166.9 crore. The CFO has sought your help in reconciling the difference between the two expense amounts. Prepare a reconciliation containing disclosure as required under the relevant Ind AS. Why the amount of tax based on the book profit is different? So friends, of course, there is certain reasons. Let us identify those reasons. So they have already given the reason that other income tax includes long-term capital gains of 10 crore which are taxable at 10%. Now we have some other income, 56 crore, which includes capital gains of 10 crore, which is taxed at 10%. Now CFO is using 30% rate. Don't you think so? What obvious, there will be difference of 20% on the 10 crore, which has not been charged. Similarly, this other expenses, your other expenses are there. These other expenses, friends, are not tax deductible. They are not tax deductible. They have been disallowed. So we need to make adjustment for that. Also, other expense include R&D of 8 crores for which 200% reduction has been made. Means in books we have considered only 8 crore, but for income tax purpose they have given us 16 crore deduction. We got some additional deduction. So obviously our tax liability goes reduced. Other income includes dividend of 4 crore. So 4 crore into 30% will be the amount of reconciliation. Agriculture income again 55 crore is exempt from tax. Again, as far as reconciling item is concerned, 55 crores into 30%, that will be reconciled. The next point they say is profit of 60 crore is earned on USA, on which we are required to pay 20%. So the reconciling amount will be nothing but 60 crore into 10%. So we just need to identify tax as per books of accounts, and tax means tax as per books of accounts, what the CFO has done, and what the actual tax I have paid, which is my tax expense. Of course, one more point is there, my friends, and that point is with respect to depreciation as per income tax laws is 25 crore, and we have considered depreciation and amortization of 30 crore deferred taxes. That is nothing but with respect to our deferred taxes. You may just go through the solution one by one. So my accounting profit is 594 into 30%, I get 178. Now tax effect of expenses that are not deductible in determining. So that was nothing but penalty, impairment, CSR. I will give the tax effect of those expenses that are not deductible in determining taxable profit, which comes to 15.30. Thereafterwards, tax effect of those expenses that are considered in determining taxable profits. So we are just adding here this 15.30 because that much of tax you have to pay as per income tax. You are not going to get deduction, but you are going to get additional deduction of 8 crore into 30%. So I am reducing it. Similarly, I am reducing the tax on exempt incomes, that is dividends and agriculture, and whatever is the differential tax, because capital gains I have to pay tax at the rate of 10%, whereas for accounts you have used 30%. So that difference of 2 and 6 we have reduced. What we got is nothing but 165.40, which is shown here. If you look properly, what is your tax expense in the question? 165.40. Now comes deferred tax point in relation to depreciation and amortization. 30 minus 25 into 30%, so it's 1.5. Tax expense deferred and reported in statement of P&L is also 1.5. So not a big issue on this. Friends, let us now move on to the next area of our discussion, that is Ind AS 34. This is just a reconciliation, which is with respect to our Ind AS 12, we can say. PQR Limited is preparing interim financial statements for the quarter 3 of the year. How following transactions and events should be dealt with while preparing its interim financials? It makes employer contribution to government sponsored insurance fund that are assessed on annual basis. During quarter 1, quarter 2, large amount of payment for these contributions were made, while during quarter 3, minor payments were made, since contribution is made up to certain maximum level of earnings per employee, and hence for higher income employees, the maximum income reaches before the year end. The entity intends to incur major repair renovation expense for office building. For this purpose, it has started seeking quotation from vendors. It has tentatively identified a vendor and expected cost will be incurred for this work. The company has a practice of declaring bonus at the 10% of its annual profits every year. It has this history of doing so. Constructive obligation, my friends. Okay. If you remember, under Ind AS 34, we had learned that if an item can be recognized as an asset or a liability or expense or income, if it fulfills the recognition criteria in my annual financial statements, then the same will be recognized as an asset, liability, expense and income if it fulfills the criteria in my interim financial statements. If an item of income can be preponed or an item of expense can be postponed in the annual financial statements, then the same item can be preponed and postponed in interim financial statements. Okay, so based on that, you are making employers' contribution to government sponsored insurance funds on annual basis. So obviously, those are our annual expenses which have to be considered. Even in our interim report, we will apply the same accounting recognition and measurement principles in interim as they are applied in our annual financial statements. How we had for tax rate, effective, weighted average effective tax rate, because tax was recognized at the year end, but we used to recognize it in our interim period also because it pertains for the whole year. Same basis, if employers' contribution to government sponsored insurance funds are assessed on annual basis, the employer's related expenses recognized using estimated average annual effective contribution rate in the interim financial statements. The second area, my friends, the second area is entity intends to incur major repair and renovation. Of course, if I can prepone that cost in my annual financial statements, then the same I can prepone even in my interim financial statements. So obviously, I cannot anticipate in my annual financial statements, then I cannot anticipate the cost in my interim financial statements. As far bonus is there, we should recognize the liability for bonus when there is a constructive obligation. Don't you think my past practice has created a constructive obligation? So we need to estimate for how much amount of bonus to be paid, obviously in accordance with Ind AS 19, and recognize this is a provision in our financial statements. Let us now move on to another question on Ind AS 41. Now friends, let us proceed for the another question, that is on Ind AS 41. ABC Limited is in business of manufacturing an apple beverage and requires large quantity of apples to manufacture such beverage. In order to satisfy its requirement of apples, it enters into 3 years lease contract with owners of apple orchards. The lease contracts are mainly of two types. Contract number 1, the owner of the apple orchard, that is the lessor, raises the apple trees to produce the apple. ABC Limited, that is the lessee, makes the fixed annual payment to the owner of the apple orchard who is required to cultivate the produce as per the specification of ABC Limited. ABC Limited harvests the apples itself for fulfilling its requirements of apples. Contract number 2. ABC Limited obtains the apple orchard from the owner, that is the lessor, to raise the apple trees for subsequent harvest of the apples to ensure that the apples are as per the requirements of ABC Limited. ABC Limited makes a fixed annual payment to the owner of apple orchard, that is lessor. Explain whether ABC Limited is engaged in agriculture activity as per Ind AS 41 in both the cases. Obviously friends, as far as case number 1, that is contract 1 is concerned, this is not an agriculture activity because biological transformation is not done by you. It is done by the lessor. As far as contract 2 is concerned, yes, it is an agriculture activity. The biological transformation is done by you. You may just go through the solution. Now, obviously, what is agriculture activity? Agriculture activity is management by an entity of the biological transformation and harvest of biological asset for sale or for conversion into agriculture produce or into additional biological assets. Biological transformation obviously includes procreation, degeneration, growth, production and all those things. Contract 1, biological transformation is managed by the owners of the apple orchard. Since ABC is not involved in biological transformation, it is only harvesting the biological asset. So ABC is not engaged in agriculture activity. Contract 2, yes, you are engaged in agriculture activity. So friends, a very small question on whether it is an agriculture activity or it is not. Now let us proceed for Ind AS 23. Harish Construction Company is constructing a huge building consisting of 4 phases. It is expected that the full building will be constructed over several years, but phase 1 and phase 2 of the building will be operational as soon as they are completed. Following is the detail of the work done on different phases of the building during the current year. Phase 1, phase 2, phase 3, phase 4, the expenditure for them 34, 64, 55 and 68, which is 221, and you have taken a loan of 200. After taking substantial period of construction at the mid of current year, phase 1 and phase 2 have become operational. Find out the total amount to be capitalized and to be expensed off during the year. Now phase 1, phase 2, phase 3 and phase 4. If you look properly friends, in the mid of current year, the construction is over. It means we will be capitalizing the borrowing cost only for a period of 6 months. Only for a period of 6 months the borrowing cost will be capitalized. And of course remaining for phase 3, phase 4, the whole borrowing cost will be capitalized. 1 and 2 only for 6 months. That is it, in the mid of the year it has happened. Interest is 2 lakh, as 2 crore into 15%, which is 30 lakhs. Cost of phase 1 first phase 2, that is nothing but we are just adding up this stuff friends, 34 and 64, 55 and 68. Total loan is 2 crore. Interest for phase 1 in the ratio we have done 1330, 317, 1669, 683. We have just divided proportionately. For phase 1 and phase 2, it is operational at the mid of the year. So out of 13,30,317 into 1 by 2, that is 665, 158 will be capitalized and added to the cost of the asset, and 665 will be expensed off. Okay, so that is the simple point friends, not a big stuff for us. And as far as phase 3 and phase 4 is concerned, my dear students, what should you do? Obviously, it will be capitalized because the work is not yet completed. Interest of 16,69,683. This interest we are talking about, which is pertaining to phase 3 and phase 4, should be held in capital work in progress till the asset construction work is completed and thereafter capitalized in the ratio of cost of asset. No part of this interest amount should be charged or expense of during the year since the work on this phase has not yet been completed. Very simple stuff. Now friends, after completing Ind AS 23, let us now move on to another question that is pertaining to Ind AS 103. But I don't think so I need to discuss this because the same question is already done in our textbook, friends, in classwork I can say. How should contingent consideration be payable in relation to business combination be accounted for on initial recognition and subsequent measurement on the following cases? 1st April 2001, A Limited acquired 100% interest in B Limited. As per the terms of the agreement, the PC is payable in following two tranche. Immediate issuance of 10 lakh shares of A Limited having face value of 10 per share. A further issuance of 2 lakh shares after 1 year if the profit before interest and tax of B Limited for the first year following acquisition exceeds 1 crore. The fair value of the shares of A Limited on the date of acquisition is 20 per share. Further, the management has estimated that on the date of acquisition, the fair value of contingent consideration is 25 lakhs. During the year ended on 31st March 2002, the profit before interest and tax of B Limited exceeded 1 crore. On 31st March 2002, the fair value of the shares of A is 25 per share. Then comes point number B. Continuing with the fact pattern in A above, except that the number of shares to be issued for after 1 year is not fixed. Fixed to fixed, then we say it is equity. I hope you remember in financial instruments, fixed to fixed is equity, otherwise it is financial liability. Rather, A Limited has agreed to issue variable number of shares having a fair value equal to 40 lakh after 1 year if the profit before interest and tax for that first year following the acquisition exceeds 1 crore. If it exceeds 1 crore, then this is what we will do. Now, my dear students, the same question has been done in our classwork. So, I would just want you to have a glance over the solution which is already there in your notebook. Same question is there. It's not a big stuff. No new stuff is there. It's the same question. Okay. If you want, you can just have a glance over the point. Fair value of the shares, fair value of contingent consideration. So, 25 lakhs. And of course, contingent consideration will not be remeasured. Why? Why I will not remeasure it? Because it is fixed to fix. We are going to issue what? In A point, further issuance of 2 lakh shares after 1 year if the profit before interest and tax exceeds 1 crore. So, fixed to fix is there. So, if it is fixed to fix, there is no remeasurement to be done. So, this 25 lakhs remains 25 lakhs. B point, it is not fixed to fix. So, what is going to happen? 2 crore plus 25 lakhs. Of course, this is fair value at the time of initial recognition. Thereafterwards, what is the fair value? That is nothing but 40 lakhs. So, I need to bring it at 15 lakhs adding up. So, it becomes 40 lakhs and that will be happening through profit and loss account. Okay. So, the same question was there in our textbook also 103. So, there is no need to spend more time on it. Now, this is nothing but graded vesting. Ind AS 102, graded vesting is there. We have graded vesting. The following particulars in respect of stock option granted by a company are available. Number of employees 400, number of options 60. Shares offered were put under 3 groups. Group 1 20% for 1 year vesting. Group 2 40% of shares offered with vesting period of 2 years. And group 3 was 40% of shares offered with vesting period of 3 years. Fair value is group 1 is 10, 12.50 for group 2 and 14 for group 3. The position has been given, number of employees 40 who have left in first year. It means 360 employees will be eligible for group 1. Estimated number of employees expected to leave in year 2 36. Estimated number of employees expected to leave in year 3 is 34. Employees exercising the option in group 1 is 350. So on 360 employees, the options will be vested, but the exercise is happening only by 350. Options not exercised immediately on vesting were forfeited. Compute the expense to be recognized in each year. Now friends, this is very simple stuff. I would say you just need to prepare for group 1, group 2 and group 3 separately. Now, how many options are there, friends? If you look properly, the total options which you have is nothing but 60. So out of 60, how much goes to group 1? How much is going to group 1 out of 60? So can I say 60 into 20%? So your number of employees is how much? I hope you remember, we used to make this way. Number of employees. That will be nothing but only those who have left out. How many? 40 is left out. So we will be having 360 employees. Number of options 12. So we have total, and then we have fair value, and the whole amount will be recognized as an expense for group 1. Whereas for group 2, what will you do? Sir, that group 2, number of employees expected, we will obviously reduce those who will retire in year 2, means expected to be retired in year 2, and then whatever is the total fair value, that will be divided by 2 for year 1 and year 2, and so on. And for year 3, we will expect how many employees will be there at the end of year 3, and whatever is the total fair value, that will be divided by 3 years. So we will be getting the solution based on this. Yeah, so not a big stuff here, friends. 360 employees into number of options 12, so fair value is 10, so we get 43,200. The whole amount will be recognized as an expense. As far as group 2 is concerned, there is 24 options, year 1 and year 2. Here 360 employees are there, expected to leave in future is 36, so we have 324 into 24 number of options, so 776. Fair value is 12.50. This total fair value will be divided in vesting period, that is 1/2, and of course year 1/3, 2/3 and 3/3. So I don't think so we need to again invest more time for this question. It's just an arithmetic part for us, friends. For what will be in year 1? So in year 1, group 1 expense, group 2 expense and group 3 expense will be there. In year 2, group 2 expense and group 3 will be there. In year 3, only group 3 will be there. So this is just a mathematic part for us. Okay, now let us now move on to Ind AS 7 wala point. So what is Ind AS 7? Cash flow. What will be the classification for following items in statement of cash flows for both banks and financial institutions and other entities? I hope you remember now. We are having banks, that is financial entities, and non-financial entities. This is what we did classification. Interest received on loans and advances given, interest paid on deposits and other borrowing, interest and dividend received on investment in subsidiaries, associates and other entities, dividend on preference shares, equity shares, including dividend paid on preference and equity by other entities, finance charges paid by lessee under finance lease, payment towards reduction of outstanding finance lease liability, interest paid to vendor for acquiring fixed asset under deferred payment basis, principal sum payment under deferred payment basis for acquisition of fixed asset, penal interest paid to supplier, interest paid on delayed tax payment and interest received on tax refund. Friends, just go through it once. Yeah. Interest received on loans and advances, of course, for banks and financials, it's operating. For other entities, it is investing. Interest paid on paid on deposits and other borrowings, it's operating and financing. Interest and dividend received on investment in subsidiaries, associates and other entities, obviously for both of us, it is investing activity. Dividend paid, whether you are a bank, a financial institution or a non-financial institution, dividend paid is always and always financing activities. Finance charges paid by lessee under a finance lease financing activity for both of us. Payment towards reduction of outstanding finance lease liability, again financing activities. Interest paid to vendor for acquiring fixed asset. So that is not operating activity for banks also, hence it is financing activity. Principal sum payment made under deferred payment basis for acquisition of fixed asset. So you pay principal amount, that is nothing but you are acquiring an asset, investing activities, friends. Penal interest received from customer for late payment. For banks it will be operating activities, and for us also it will be us in the sense non-financial entity, it will also be operating activity because it is received from customer. Penal interest. Penal interest paid, obviously again operating activities. Interest paid on delayed tax payment, interest received on tax refund, obviously all those things are operating activities. Okay friends, so this is all about our identifying whether it is operating or financing activity. Not a big issue. Just remember that if I'm receiving interest from supplier, I'm receiving interest from customer or paying interest to supplier, that forms part of my operating activities. So now after completing Ind AS 7, friends, let us move on to Ind AS 38. That is our intangibles. So the question says an entity has an intangible asset in form of product protected by patented technology, which is expected to be source of net cash inflow for at least 15 years. It has been recognized in the books at an initial date of 12 lakh rupees. The entity has a commitment from the third party to purchase that patent in 5 years for 60% of the fair value of the patent at the date it was acquired, and the entity intends to sell the patent in 5 years. The company is amortizing the asset in 15 years, considering its residual value to be zero. Annual amortizing the asset in 15 years, considering residual value to be zero. Annual amortization charge to P&L is 80,000. State whether the accounting treatment done by companies in accordance with Ind AS 38. If not, then calculate the annual amortization of the intangible asset and also the amount at which it is reflected in the balance sheet. Now friends, under Ind AS 38, we have studied that an intangible asset can have finite useful life or it can have indefinite useful life. If it is having finite useful life, then obviously it should be amortized based on the estimate period in which we are going to get those cash flows or benefits from use of this intangible. If you look properly, here the life is 15 years. But we have a third party commitment. Please read this point. To purchase the patent in 5 years for 60% of the fair value of the asset on the date it is acquired, and the entity intends to sell the patent in 5 years. So now we are not supposed to amortize over the useful life of the patent based on the capacity of the patent right to give economic benefits. We are expected to amortize the patent based on the life in which we expect to get those economic benefits. Which means, in this question, my dear students, we need to amortize the patent in 5 years. And also one point, as per Ind AS, the scrap value of patent is always considered to be zero. Patent in the sense intangible asset is always considered to be zero. So friends, in this question, we are having a third party commitment to buy it at 60%. So can I say if the third party is going to buy that patent right at 60%, that commitment is available. Hence, we are going to recognize even the scrap value. It is always zero unless there is a third party commitment. So here obviously we have a third party commitment to buy that intangible asset. So going through the answer, cost of intangible asset, the residual value, that is 60%. So depreciable value is only 480 and 480 is to be divided in 5 years. So my annual amortization will be 96,000 per annum. So the entity's accounting treatment is not correct. accounting treatment done by company is in accordance with Ind AS 38? No, it is not. Now, coming on to Ind AS 115. Please read the question, friends. A Limited owns 20 resorts across India. Every customer who stays in any of the resorts owned by A Limited is entitled to get points on the basis of total amount paid by him. Under this scheme, 1 point is granted for every ₹100 spent for stay in the resort. As per the past experience of A Limited, the likelihood of exercise of this point is 100%, and the standalone price of each point is ₹5. Customer X spends 10,000 in one of the resort of A Limited. What will be the accounting treatment for the points granted by A Limited? Yes, my dear students, if you remember, don't you think there are multiple performance obligations? In sense, you remember those 5 steps? When the customer is paying me 100 rupees, the customer is also paying me for future goods and services. Because for every 100 rupees spent in the resort, you are going to get 1 point, and that 1 point is equal to ₹5. So today when I receive this 100 rupees, I should allocate this 100 rupees based on the goods and services provided today and the goods and services that will be provided in future. So in the ratio of SSP, we will be bifurcating this 100 rupees in the ratio of SSP. So what is the ratio of SSP? I can say very simple, 105 only. Of course, what is the amount spent? 10,000. So if the amount spent is 10,000, how many points are there? There are 100 points. So we are going to give them 100 points. Each point is of ₹5. So can I say the customer has the right to buy goods or services worth 500? So this 10,000 amount that is received will be divided in the ratio of 10,000 and 500 in the ratio of SSP, and the amount of 10,000 out of which whatever amount comes by dividing it in the ratio of SSP, that will be considered as revenue now, and the amount of revenue pertaining to this here, whatever amount comes, that will be considered as a revenue as and when the points are redeemed. Clear, friends? So this is the solution for 9524 in the proportion of standalone selling prices and 476. Of course, this is the theoretical part. Now moving on to question number 14. Company A has financial year ending on 31st March 20x0. On 1st June 20x0, the company has classified its division B as held for sale in accordance with Ind AS 105. How PPE, for which the company has adopted cost model, shall be measured immediately before the classification as held for sale on 1st June 2000 or 20x0. Now friends, as per the principles of Ind AS 105, whenever you classify an item as held for sale, what are we supposed to do? The moment you classify as an item as held for sale, on the date of classification, we should measure that item using the principles which are applicable to that item. In sense, it may be Ind AS 16 or Ind AS 40 or Ind AS 38, that is intangible. Now if you look properly, on 31st March 20 you already have a PPE, so it would have been depreciated till 31st March 2000 20. Now on 1st June 20, which means this is the day you classify division B as held for sale. So from 31st March 20, that is April and May, 2 months depreciation will be charged in accordance with the principles of Ind AS 116. And then on that date, we get the carrying amount. Thereafterwards, the principles of Ind AS 105 will apply. Okay. Moving on to Ind AS 37. HVCL manufactures heavy equipments for construction industry. An order for supply of 90 equipment was received from ABIL. The unit price of equipment was agreed at 190 lakhs each. 64 equipment was supplied during 1-2 and the balance quantity remaining to be supplied is on 31st March 2002. HVCL has 5 equipments in its inventory as on 31st March 20x2. HVCL considered that the contract was onerous contract and therefore the NRV of inventory has been taken as value of inventory as on 31st March 20x2. The management of HVCL contends that the cost incurred towards administrative overheads, finance charges, R&D expense, sales overhead, headquarter expenditure are considered as period cost and hence not considered for the creation of provision. The same is not included in computation of unavoidable cost. The management of HVCL has submitted the details of cost that have been considered for creation of provision towards onerous contract. Material cost includes the cost of material procured, cost of freight and insurance incurred for material procurement and handling, loading and unloading incurred. Labor cost and factory overheads includes salaries and other expenses of direct production department and also expenses allocated from indirect departments to direct departments. Material overheads includes salaries and other expenses including expenses allocated from other departments booked under departments linked with material like purchases, stores and quality control. Accordingly, provision has been made considering the above cost only. The value of provision created for 21 remaining equipments to be produced is as per the working shown below. Cost of production, that is which includes material, labor cost, overheads and material overhead. Selling price 190, differential cost per equipment is 9. So differential cost of 9 lakh into 21 we have 189. Whether company's accounting treatment of cost for creation of provision towards onerous contract is in line with provisions of Ind AS 37. So friends, after reading the whole question, it's so much big, so many things, but a very simple question is it is. Just the details are too much. The question is with respect to what cost should be included while creating provision against onerous contract. Now, if you remember what is onerous contract, onerous contract is a contract wherein the unavoidable cost to meet the obligation under a contract exceeds the economic benefits arising from such contract. Then, Ind AS 37 wants us to create a provision for such contract. The quantum of provision to be created, that is the unavoidable cost or any penalty, whichever is lower. Because what will happen if the economic benefit is 100, the unavoidable cost is 120. So I'll say, okay, let's fulfill the obligation. So I'll be having a loss of 20. But if I can cancel the contract and have to pay damages of 15, then the standard says create provision for 15 because obviously you are going to cancel that contract. Here the point comes, what amount should be considered for the purpose of calculation of your unavoidable cost? So friends, yes, the upper part was with respect to that we have agreed unit price to sell at 190 lakh, 64 equipments were supplied, balance were to be supplied as on 31st March 2. On we are having some 5 equipments and now we are considering the contract is onerous. Now what we are saying that the point says should not be considered in creation of provision. Do you agree with this? Obviously yes. These are the costs that are not in relation to that particular contract. In any case, these expenses would have been incurred. We are talking about those unavoidable costs that would be incurred in order to fulfill the contract. That only will be considered. This cost in any case is going to happen only. So my dear friends, they have not been included. Yes, it is very clear stuff. And now what will come in material, what will come in labor, material overheads? Yes, these all expenses will be included for the purpose of calculating your unavoidable cost. So your selling price is 190. The cost to complete is 199. So 9 lakhs is the differential cost into 21 equipment. So 189 is the provision to be created. So that is obviously correct. The unavoidable cost under the contract reflects the at least net cost of exiting from the contract, which is lower of the cost of fulfilling it and any compensation for penalties arising from failure to fulfilling it. The stuff which I spoke. Okay, so the same thing. Period cost should not be included. Very much correct point. Nothing wrong in this stuff. So friends, accordingly HVCL has correctly measured the cost of creation of provision for onerous contract by considering material, labor and directly related to production. Now friends, proceeding further, next question, which is nothing but combination of Ind AS 2 and Ind AS 16. A retailer company imported goods at a cost of 1,30,000, including rupees 20,000 non-refundable import duties and 10,000 refundable purchase taxes. The risk and rewards of ownership of the imported goods were transferred to the retailer company upon collection of the goods from the harbor warehouse. The retailer company was required to pay for the goods upon collection. The retailer company incurred 5,000 to transport the goods to its retail outlet and further 2,000 is incurred for delivering the goods to its customer. Further selling cost of 3,000 were incurred in selling the goods. State whether delivery charges, selling expense will form part of cost of inventory. If not, then why? Also calculate the cost of inventory. Very simple. Under Ind AS 2 friends, we have learned that cost includes purchase cost, conversion cost and other cost. And in case of other cost, which cost should be included? All expenses that are necessary to bring the inventory in present location and condition. It means those expenses which will change the characteristics of the inventory. It will make it saleable. If you look properly, delivery charges, selling expenses, they are not necessary to bring the inventory in present location and condition. They should never form part of inventory. Also, we had studied that some expenses will never form part of your inventory valuation. General admin overhead, selling and distribution overhead, abnormal losses. They are not considered as cost of inventory. Here what should we do is nothing but the cost of 130 including 20,000 of non-refundable import duties. So let it be included. 10,000 of refundable purchase taxes. Anything which we are going to get refund of, we will never include it in the cost of inventory. The same should be deducted. The retailer company incurred 5,000 for transportation of the goods to its retail outlet. So this 5,000 will also be included in my cost of inventory. As far as selling cost of 3,000 and 2,000 of delivering cost. That 2 expense will not be included in my cost of inventory. Okay, so one lakh plus 20,000 non-refundable plus 5,000. Alternatively, you can also present the data in this way, that 130 minus 10, that is 120 plus 5. Now, let us move on to the next area, that is 16. Company A incurred 20,000 as cost of restoring the site on which the item of PPE was located. This item was used for manufacturing of goods, and requirement for restoring will arise due to manufacturing of goods. What will be the treatment of this rupees 20,000 in the books of company A, analyzed on the basis of provision relevant to Ind AS? Friends, the point which is important is this only. We have learned that the cost of decommission forms part, present value of cost of decommission form parts of the cost of PPE. But in this case, this 20,000 will not be incurred, will not be forming part of my PPE. Why? The reason is very simple. This obligation is not arising on account of installation or acquisition of that PPE. This cost of 20,000 of restoring the site is arising on account of manufacturing of goods and not on account of acquisition of our PPE. Hence, this 20,000 has to be expensed off. It will go to profit or loss. Of course, part of my inventory, and that inventory, if it is sold, then it goes to P&L. Will be added to the cost of inventories. Because this cost is incurred in relation to manufacturing. So nothing, but it will not be added to the cost of my PPE. Now we move on to Ind AS 33. Nothing but same question number 10, not exactly same, but the concept is same of question number 10, which is there in our JKC textbook. Company S is subsidiary of company P. Following facts in respect of company S. Company S 10,000 ordinary shares, 1,000 options outstanding, of which company P owns 9,000 shares and 500 options respectively. The options have an exercise price of 40. The average market price of company S ordinary share was rupees 50 in 2001. In 2001, company's S profit was 30,000. Following facts are in respect of company P. Company P has 5,000 ordinary shares outstanding. In 2001, company P's profit, excluding any distributed or undistributed earnings of subsidiary, was rupees 7,000. The option outstanding are dilutive at P level also. Determine the diluted EPS of company P. Now, before determining the diluted EPS of company P, don't you think on standalone basis we need to find out for company S how much is dilution? If you look properly, from company's S angle, what would be my EPS? Can I say my EPS is nothing but 10,000 ordinary shares, and this is 30,000. That is rupees 3. As far as DEPS is concerned, what would be the DEPS? So we have 30,000 divided by 10,000 plus. Now the number of options that will be issued free of cost, or for which no consideration will be received. 10,000 into 40 divided by 50. It comes to 200. 30,000 divided by 10,200. Somewhere my dilution is 2.94. This is for company S. Now friend, they are asking us not companies S, EPS and DEPS. They are asking us what? They are asking us what is the diluted EPS, and that too for company P. So for company P, what would be the diluted EPS? Very simple, for company P. Now what is its earnings? Company P's earnings, its own earnings was 7,000. Yeah, it is 7,000. Plus earnings of subsidiary. Now how much earning of subsidiary will be there that is attributable to us? Of course, based on the 2.94 into how many shares the subsidiary has. The subsidiary is having 10,000 ordinary shares. So 2.94 into 10,000. Out of that, can I say 9,000 by 10,000 belongs to me? Plus 2.94 into 200. Why 200? Option part. Out of this, how much belongs to you? Options. 1,000 option belongs to you. This two will be added up. And thereafterwards, friends, the total earnings will be divided by the number of shares what we have. Because if you look properly, when I did this working 2.94, can I say this 2.94 belongs to two category? Option holders and the existing shares. So don't think multiply by 3. We are finding out diluted EPS. So when this point comes, some of you might be thinking that instead of 2.94 it should be 3. No, it should not be 3. We are not finding out company's P's EPS. What we are finding out is company P's diluted earning per share. Hence I have considered it to be 2.94, which is a diluted earning. This is what we should do. Yeah. Company P's earning, then company's P shares of company's S earning attributable to ordinary shareholders, 2.94 into 10,000, and of course 90% belongs to me. 2.94 into 200, only 50% belongs to me. So both is added, and number of shares what we have is 5,000. So our diluted earning per share is 6.75. Clear, my friends? Okay, now let us move on to another question. Question number 18. That is with respect to Ind AS 32 and 109. On 1st April 2001, an entity granted an interest-free loan of rupees 5 lakhs to an employee for a period of 3 years. Interest-free loan to an employee for a period of 3 years. The market rate of interest or similar loan is 5% per year. On 31st March 2003, because of financial difficulties, the employee asked to extend the interest-free loan for further 3 years. The entity agreed. Under the restructured terms, the repayment will take place on 31st March 2007. However, the entity only expects to receive a payment of 2,50,000 given the financial difficulty of the employee. Explain the accounting treatment. On initial recognition of loan, after giving effect of the changes in the terms of the loan as per 109, support your workings and answers. Okay, that is the stuff. Now, my dear students, interest-free loan. What is the market interest rate? Is 5%. So, can I say we need to find out the transaction price? That is nothing but the fair value of the loan. Discount this 5 lakhs because cash flows in the year 1, year 2 is 0. In the year 3 only we are going to get the cash flows. That is 5 lakh. This 5 lakhs will be discounted using 5%, that is market interest rate. So 5 lakhs into discounting factor at the rate of 5% for the third year, we will get the transaction price. Difference between the transaction price, that is nothing but the fair value of the loan, and the amount received will be treated as employee benefit cost, which will be amortized over the 3 years period. Then what is happening? So this is what our initial stuff is there, and we will be preparing the amortization table. This all things we have already done. But friends, then comes some kind of modification. Now what is the modification? On 31st March 2003, that is obviously at the end of second year. So at the end of second year, whatever is the balance in my amortization table, based on that, because of financial difficulties, employee is asking us to extend that for further 3 years, and we have agreed to it. And now when we agree to it, we say we are going to receive a payment of 2,50,000 only. Now if I am going to receive the payment of 2,50,000, don't you think I have to find out what is the present value of the 2,50,000? Difference between the present value of that 2,50,000 and the value, amortized value at the end of second year, that difference indicates impairment loss. Okay, and it will be charged to our profit or loss account. Loan is not at market interest rate, and it is not recorded transaction price of 5 lakhs. Instead, the entity measures the present value of future cash inflows discounted at market interest rate, which comes to 4,32,000. 5 lakh, 4,32,000. Difference between this 68,000 is accounted as employee benefit expense, prepaid employee cost. So that is simple. Then you will prepare an amortization table. This is how your initial amortization will go. Second year, it means you are here 476. 280 is the amount at which the stuff is there. Now on 31st March, the carrying amount of the loan receivable is 476 280. That is true. As a result of modification, what is going to happen? The present value of estimated cash flows is recalculated to be 2,05,750 using the original interest rate. That is true. Why do we do this way? Because the question clearly mentions extend the interest free loan for further 3 years, excluding the 3 years. So the value comes to 2,05,750. Difference between these two is nothing but my impairment loss, and that 2,05,750 will now be again amortized, and at the end of the 4th year we will be receiving 250. So this is how it will go. Okay friends, 476 280 and 2,05,000. Now let us move on to the last leg. 2 questions are left out. We'll complete off in our RTP discussion. An entity owns a 2-story building. Floor 1 is rented out to independent third parties under operating lease. Floor 2 is occupied by the entity's administration and maintenance staff. The entity can measure reliably the fair value of each floor of the building without undue cost or effort. How the same is classified and presented in the balance sheet of relevant Ind AS? What will be the accounting treatment as per relevant Ind AS on initial and subsequent date? Now can I say floor 1 will be investment property only? Yeah, when both the properties, investment property and owner occupied properties, are combined, what we do? We say that that particular property will be considered as investment property if we can enter into a finance lease independently for it, or we can sell off the property independently. Then we say it is nothing but our investment property. Now in this case, it is clearly identifiable that floor 1 is rented out. Floor 2 is also an independent for it. So floor 2 will be PPE and floor 1 will be investment property. Principles of Ind AS 40 will apply to floor 1 and principles of Ind AS 16 will apply to floor 2. As far as investment property is concerned, initial recognition will be at historical cost and subsequent recognition will also be at historical cost, obviously as reduced by accumulated depreciation. Revaluation model is not allowed as per Ind AS 40. Of course, for the purpose of disclosure, we will be disclosing that fair value of that investment property. As far as owner occupied property is concerned, friends, can I say owner occupied property? For that we can use either cost model, that is historical cost model, or we can use revaluation model for subsequent treatment. So not a big stuff there. Investment property. You can either go with cost or you can go with revaluation model. Now, the last point of Ind AS 8 and 34, that is the 20th question. While preparing the interim financial statements for the half year ended on 30th September 2001, entity notes that there has been an under accrual of certain expenses in interim financial statements for first quarter ended on 30th June. The amount of under accrual is assessed to be material in context of interim financial statement. However, it is expected that the amount would be immaterial in context of annual financial statements. The management is of the view that there is no need to correct the error in the interim financial statement, considering that the amount is expected to be immaterial from the point of view of annual financial statements. Whether the management view is acceptable, obviously no. Why? So at the time of preparing interim financial statement, if something is material, then it is material and has to be adjusted. At that point of time, you can't say that from annual financial statements the amount or that item is immaterial. We have to identify that particular item or amount based on interim financial statement and not annual financial statement. So obviously those material items have to be considered. A theoretical solution: they contain either material errors or immaterial errors made intentionally to achieve particular presentation. We are supposed to assess relation to interim period data and not annual data. Okay, so the overall point is that only that materiality aspect will be assessed at interim data level and not at overall level. So friends, that is the end to our RTP discussion. Thank you very much for watching, and my best wishes, all the best for your exams. Thank you.